Hello and welcome everyone to the Manulife Asset Management's Market Outlook webinar on Asia Pacific REITs and Philippine equities. I am Zed Matubis from Manulife Asset Management and Trust Corporation. I will be facilitating today's webinar. Our guest speakers for today will share their insights on their respective asset classes and how long-term fundamentals can win over short-term volatility. If you have questions for our speakers, you can send them to us via Slido. Visit www.sli.do, then enter the event code MAMTC or MAMTC, or simply scan the QR code flashed on your screen right now. We will endeavor to answer as many questions as we can towards the end of the presentation during the Q&A. Please also note that this webinar is recorded and the recording will be posted on our social media account. Please watch out for that. I'll give you a few moments to look at the Slido details, but don't worry, we will display these details once again during the webinar. Okay, let's get started. To talk about the outlook for Philippine equities, allow me to introduce our first speaker. Mark Canizares is the head of equities for Manulife Asset Management and Trust Corporation. He is responsible for the management of the various Philippine equity strategies of Manulife Philippines, Manulife China Bank Life Assurance Corporation, and Manulife Asset Management and Trust Corporation. I'll now turn you over to Mark. Mark?
Good afternoon, everyone. I hope everybody's safe watching this webinar from the safety of their homes. So we're here to talk about updates and a little bit of review on the equity markets following what happened over the last couple of weeks. Let's move on to the next slide. So year to date, this is as of end April, the stock market was actually down. We closed at 5,700. So we are down about 27% year to date as of end April, mostly due to COVID-19 concerns. So I think nobody already remembers what happened in the first part of the year where we had a volcanic eruption. Everything was eclipsed by COVID-19. As of today, we are down about 28% year to date, and we're at around 5,500. So the next bullets show you that the reason was basically COVID-19 cases when local transmission happened in the Philippines that led to a rapid rise in infection. So the market was worried. Growth forecasts are also at risk because of lockdowns that were implemented to contain the virus and preserve the economy. So what we're looking now are the government efforts to respond to the pandemic, and we believe this is critical to ensure that the health crisis does not turn into a financial one. Towards the end of the presentation, we'll give you an outlook on the sectors that we prefer and how we have shifted our strategy to account for this new normal in investing in the equity markets. So we basically we prefer sectors that are less impacted by business disruptions following COVID-19. So moving on to the next slide. So we've done a screen of how volatility has increased for the Philippine market. So the global markets have actually been quite volatile as well. So in the Philippine scenario, we've done an analysis for the first 3 months of the year. We were trying to define volatility here as the number of day-on-day changes that the PSE moved above or minus 2%. So you would notice that the left side of the chart shows you that in January, we only had 2 days where the market was up or down by 2% on a day-on-day basis. By the time we reached February, we still didn't have local transmissions here. We only had 4 days of plus minus 2% changes in the market. By the time we reached March, we've had 11 days of these volatile price changes for the market. And this also includes the time that the community quarantines were announced, and also the 13% drop when trading resumed. So if you recall, the past couple of weeks, we were closed for 2 days for the stock market, and then the market dropped 13% when trading resumed. So for March, on all the way to May, volatility has significantly increased. So just as a measure, there are only 18 trading days in March. And of that 18 trading days, 11 days were quite high in terms of the volatility as measured by the day-on-day changes. So this is because, of course, COVID is giving some concerns on what will happen to the market, mainly because of the disruptions on the economy that it will do. The community quarantine has basically shut the economy, so that would have an impact on consumer spending, that would have an impact on manufacturing, basically on all economic activity. And when you price that into the impact to the shares or the stocks in the index, then certainly that would also imply that earnings, revenues would also take a hit for the year. We've seen the market already report earnings for the first quarter. Certainly, there have been significant decreases in revenues and net income for the companies that have reported so far. But remember that the first quarter of this year only included 2 weeks of the ECQ. So by the second quarter, we will see most likely the bigger impact of how the ECQ or the GCQ, wherever province we are, has impacted the listed companies, because you would have a full 2 months of the shutdowns and how it has impacted the companies and the earnings of these companies. So moving on to the next slide. We are of the view that the response to the pandemic is critical to ensure that the health crisis is contained. Of course, we would want this solved right away, and already there are expectations that we will have a recovery going into 2021. But certainly for 2020, we've seen that the impact cannot be escaped in terms of output. I think on the left side of the chart, you will see that the initial forecast for GDP growth for the Philippines was as high as 7%. And you would see that fall. We also released the first quarter actual GDP numbers, and that already showed you a decline of 0.2%. And I think as of today, we're looking at GDP growth of -1 to 3% for the full year 2020. This is not an isolated case. So the Philippines is not the only one that is expected to report weaker growth. I think earlier on, around March or April, there have already been statements that global economic output would also decline. So this is not unique to the Philippines, but rather something that is affecting almost all the countries globally, especially those with high linkages to the supply chain globally. On the right side of the chart shows you that in terms of the breakdown of Philippine GDP, 57% we believe is at risk, because this is the service sector. So most of the sectors that would be labor intensive, client facing, those who would be affected by social distancing, would be the ones that would most likely have an impact because of a reduction in the manpower that we employ or a delay in the restart of these sectors. So that's more than half of the GDP. And as we move into a more relaxed form of quarantine, we are closely watching what will happen to that sector and how they adapt as the economy moves forward. The next slide, please. So we've also mentioned that the government has efforts to make sure that the economy keeps going. Basically, we want to save incomes. We want to make sure that spending continues. And there would be a section of the economy on the informal side that would be on a no work, no pay basis. There would be the marginalized. So we believe that all the efforts that the government is doing is good, in that they plan to make sure that they support the sectors that need it the most. As of this writing, we have identified that there's around 1.4 trillion, or about 7% of GDP, that the government is planning to spend. And this is in line with what we've seen globally. So I think we've seen across countries about 2 to 15% of GDP that they plan to spend to support incomes, to support families. And these, for the Philippines, are outlined on the right-hand side of the chart. You would have the Bayanihan Act. There is something that's allocated to the health department. The tourism industry is also being supported. There's a budget for your SMEs. For those of you who have outstanding loans with the banks, you've seen that there have been payment holidays, loans and interest payments, and finally, there would be wage subsidies for employees of small businesses. So all of these efforts are, we believe, designed to keep the lights on for the economy. So think of it as something like an economy that's put into suspended animation while we're waiting for the virus to pass. And once that's done, hopefully when everything resumes, we would be able to go back to work. People would start to earn money again. They would be able to start spending again. But in the meantime, the 1.4 trillion, that's designed as a stopgap measure to make sure that there's money that's floating, there's money that's going around, and there are the spending would not be curtailed too much in terms of the Philippine economy. Next slide, please. So how do we position in terms of the new normal? I think that's what is in everybody's minds. We've had to make adjustments on how we think and how we approach the Philippine market, given that, of course, we will be operating in a new environment. Given that there's still no cure, there are still cases of COVID, and we're still having some increase in numbers from some of the cities in the country. So you can see here on the right side, we've made a graphic on some of the sectors, namely your consumer staples, the discretionary side, the banks, properties, telcos, and the utilities. The first one shows you if we became more bullish or became more bearish after the pandemic hit the country. So in summary, basically what we basically like are sectors that would be resilient given the current environment. And in terms of strategy, we're also rotating to sectors that would be, number one, the first to restart once the economy starts to reopen, even if it's on a partial basis. Or we're also looking at industries that would be able to change and adapt to the new operating environment. In general, we are cautious on service-related industries as they would be the most labor-intensive sectors. But while we like the prospects of, we also like the prospects of industries that are less labor-intensive, and particularly those that have been able to leverage on technology to adapt to the new social and economic structures post-COVID-19. So the ones that have check marks are the ones that we like. So one thing that we would be looking at, for example, would be your consumer staples. And what drives that is that there would be strong growth as people stock up supplies. So these would be your supermarket operators, your 24/7 convenience stores, basically the ones that would be replacing your restaurants because people have now gone to eating at home. So stocking up on your pantries, that would have an impact on your consumer staples. On the other hand, your consumer discretionary is something that might have weaker revenues going forward because we would have store closures or we had store closures and that would have no sales. On the banking side, we've seen that the banks have adapted and they've leveraged on technology via digital banking platforms. While on the property side, we are a little bit cautious because of no rental income from malls and there would be weak residential sales. So again, if you remember how service is structured for your property sales, this is a high contact industry. And we've been hearing that for the duration of the ECQ, when movement was limited, there were certainly limited sales in terms of this sector. On the telco side, we also like this better, given that people are now working from home. And certainly this webinar would have been live if not for COVID. So we're doing that as well, leveraging on technology. So I think in terms of technology, the telecommunications sector has been able to leverage on that. And I think as a defensive pick, we still prefer the utilities, given that the demand is sticky for the product. So utilities would cover your water and your electricity. So you can see here that the returns year to date as of March 30, for those that are with a tick check mark, they relatively outperform the index, while those that are expected to not benefit from or be able to change right away would have underperformed the index so far. Next slide. So this is just, I think we get this question a lot. How do equity markets react and how do we position? I think the pandemic has showed us that recent events that equity markets are not really for short-term investors. We would have seen that on a shorter term period, you will see that your returns as of April 30 on a 1 to 5 year basis are still on the negative side. So minus 28%, minus 26% on a 3-year, and minus 28% on a 5-year. And bulk of this happened during the first quarter of this year. So towards the tail end of that time frame, you would have seen that the drop actually ate up your returns. But once you move to a longer term horizon, namely your 10 and 15 years, you would have had a cumulative return of as much as 211%. So these include a lot of the negative events that have happened over that last 10 or 15 years. So certainly it helps you ride the volatility by looking at long term. And also, I think in terms of investing in equities, this also highlights that given the recent pandemic, you really have to assess your ability to take on risk. If you have that ability to take on risk plus the horizon that is expected for holding equities, then certainly it still is a good way to grow your money. But of course, you have to be aware of the risks that are present in this asset class. Next slide. So risks to our view. So what can still happen that might push the market down? Because we've seen the market drop close to 4,000 at one point when we resumed trading in March. So we believe that the worst is over, but of course, we're still mindful of what risks remain. So if the quarantines continue to get prolonged, or if the government fails to handle the situation properly, then you'll see a rise in infection. So we do not want to see these things happen. From a corporate side or corporate earnings side, we don't want to see countries or companies defaulting due to lack of economic activity, because that would certainly spill over to other sectors. You'd see unemployment, you'd see business shutdowns, and that would have negative effects on output. And of course, if there's a second wave of infections, that would have an impact. If we certainly impose the quarantines again, then we would see what we've seen over the last 8 weeks, wherein output basically stopped. So these would be the risks of a downturn or another downside in the market if you're looking at investing currently. But what would we like to see? There are 4 things we'd like to see. So the next slide will show you that. I think the main question that's in everybody's minds is what would bring back investor confidence in market, given the volatility. So we're now used to having days where the market falls by 4%, rises by 7%, falls again by 5%. Basically, the market has been sideways in terms of the trading activity over the last 2 to 3 weeks. But what would we like to see? We are looking at the response from the national and local governments in terms of them having one view, and that would have some positive impact. And that could lead to the economy being saved from further falling and can restart. This would mean that output would not fall any further. And of course, what we would like to see is that COVID-19 infection rates flatten, and the risk of a second wave or a third wave of infections start to disappear. So in terms of impact, that would have an impact on labor supply, meaning your workers, that would be stable. Consumer confidence would also start to return. People will start to spend again. And social costs, mainly your amelioration programs, your dole-outs, the costs related to that would start to fall. The third point is that companies can we want to see companies adapting and optimizing their workflow processes in light of the pandemic. So these would be tied to their ability to evolve or to adapt to the new situation. And that would be positive because it would lead to companies restarting production. And from an accounting perspective or an earnings perspective, we'll start to see revenues and earnings reappearing again. And lastly, I think the impact was quite fast when COVID hit the market, and everybody's fearful of what will happen once economies start to have increasing number of infections. So the last thing we would like to see is, of course, a development of a vaccine or tests that would allow instant diagnosis. And that would lead to fears disappearing, and COVID-19 would be written off as a historical event. And if you see the fourth bullet right away, then I think the recovery would be quite fast. Next slide. Okay, so that is the last slide. I will turn you over to Zed again, and I will be back to answer your questions after the next speaker. Thank you, everyone.
Thank you, Mark. Those were indeed great insights on the Philippine market. We are already seeing some questions coming in at Slido. Great questions so far. Please continue to send in your questions. Here are the details again. Go to www.sli.do and enter MAMTC as the event code, or scan the QR code that is flashed on your screen. Also, for people already in Slido, you would have noticed right now that the poll tab is already activated. So if you click the poll tab, you will see there a quick 3-question survey. You may answer it now or later after the event, but please do look at it during the webinar. This will help us in our next webinars that we're going to do. Moving on, our next speaker is from Manulife Investment Management in Singapore. Yumin Nang is Director and Portfolio Manager of Equities. She is responsible for our Singapore equity, balanced and regional REIT portfolios. Today, she will talk about the outlook on real estate investment trusts in the Asia-Pacific region. I'll now turn you over to Yumin. Yumin?
Thanks, Zed. Good afternoon, everyone. Thanks for making time to join me for this webinar this afternoon. I hope you and your loved ones are keeping well and healthy in these difficult times. With this unprecedented global pandemic, where almost half the global population are being kept at home, equity markets have naturally taken a very strong beating in the last few months. Despite REITs being key beneficiary of the aggressive monetary policies that were undertaken by central banks in the recent period, Asia-Pacific REITs were not spared as well in this market sell-off. The key concerns for investors has been the income certainty and visibility for the real estate REITs, given that the malls, hotels, offices are closed, people are asked to stay at home, and social interactions are discouraged. The ground situation remains highly uncertain and rapidly changing across the Asian markets, but we are seeing that the lockdown measures has been gradually being lifted in the key economies like Australia and Hong Kong. It will be very timely for us now to go back to the fundamentals of the Asia-Pacific REITs. Next slide, please. By virtue of regulatory obligations, REITs under regulations will have to pay out at least 90% of their income receipts to enjoy tax transparency from the tax authorities. This income feature for Asia-Pacific REITs has provided a buffer in the last decades when markets move lower, and also enhance total returns when market appreciates. Indeed, this year will be an unprecedented year, as we have seen government making orders as well as making requests for all landlords or real estate owners to share the pain with their tenants, especially those in the retail as well as hotel sectors. There could be temporary 1 to 2 quarters kind of income disruption for the REITs this year, but fundamentally on a medium-term basis or on a full-year basis, most REIT managers are willing and are committed to stick with the high payout ratio to their shareholders. Next slide, please. Post the recent sell-off of the market, Asia Pacific REITs offer investors a very attractive headline yield of close to 6% per annum. This yield compares very well with the respective local equity markets in Australia, Hong Kong, and Singapore. The high yields also reflect market and investors have priced in a certain uncertainty in the income for the listed REITs, given how malls are closed and a certain landlords are requested to give rent relief and rebate to tenants that are very badly affected by COVID-19. On the next slide, on a risk-adjusted returns basis, even taking into account the sell-off in the first quarter of this year, the risk return adjusted profile for the Asia Pacific REITs still compare very well compared to the global equities, Asia ex-Japan equities, or even the global REITs portfolio. On the next slide, as spoken before, yield spreads have widened very significantly above their historical averages on the back of a sharp decline in government bond yields, as well as correction in the share prices of the REITs. We believe at the lows in March, a lot of negatives have been priced into the Asia Pacific REITs, and in a post-COVID and normalized situation, these very wide yield spreads are very attractive key feature in a low rates environment. The key underlying compelling reason to buy into hard real estate assets has always been the income pickup over the risk-free rate. And over the past months, risk-free rate has continued to decline sharply, and we are talking about Singapore and Australia and Hong Kong. Risk-free rates are all below 1%, and investing in real estate assets offers investors with a long-term and medium-term horizon a very attractive income pickup. On the next slide, focusing back on a very normalized situation, we believe in a low rates environment, REITs have historically performed well in terms of performance versus the relative broader equities market. While near term, the income and share prices might see some volatility as well as potential impact from government orders of closures and lockdowns, structurally and fundamentally, it remains a sector to own when the economies recover. Next slide, please. A lot of recent attention on REITs have shifted to balance sheet strength post the steep market correction back in March, where there was seen to have some liquidity as credit freeze in the financial markets. Fundamentally, we are comfortable with the Asia Pacific REITs in terms of their balance sheet strength and credit metrics. Asia REITs, when compared to the last financial crisis, currently structurally has a lower gearing level, a much higher interest cover ratios, limited refinancing needs, as well as a high percentage of their debt in fixed rate notes. As such, we believe there is no reason and no risk that any of the Asia REITs will have to do very dilutive rights issue exercises as per what in current environment versus back during the GFC where we saw a lot of fundraising undertaken by Australia as well as Singapore REITs. On my last slide, in these volatile times, it's much more important than ever for investors to focus on fundamentals of each REIT. At Manulife, we have always stressed that buying into REITs is not buying into the headline yields of each REIT, but to assess the fundamental, the sustainability, and the certainty of this income. In current environment, it's very important for investors to put much more attention to two key metrics will be the tenants profile, the diversification of the tenants, the exposure to small middle enterprises and small business, and risk of income or rent shortfall from the tenant base. The other key feature will be the balance sheet strength. In current environment where some of the REITs might have to offer their tenants rent deferment, it's very, very important that their balance sheet will be able to withstand some cash flow mismatch in current environment for the short term. With that, I'll hand over to the host.
Thank you, Yumin. This asset class indeed continues to show good fundamentals, particularly now that the interest rates are very low. So again, your questions can be sent via Slido. We're showing the details again there. So we'll start. Let me read the first few questions here. I have a question here for Mark. Mark, this question comes from a client named Warren. Given the partial change in the lockdown, the modified quarantine rules, do you see what type of recovery do you see in the Philippine stock market? Will it be U-shaped, W-shaped, and what does it mean for investors?
Well, I think for the Philippines, generally what we're seeing is a slow recovery. I think as of today, we still have a lot of cases and we're still adding around 200. But certainly, the reopening or the gradual reopening of some parts that were on an enhanced quarantine would help restart some sectors. So in terms of the impact to the stock market, so those companies that were previously were not able to operate would start to at least generate some revenues and income. So in terms of expectations on earnings, the longer the lockdown, the bigger the downgrades. So if we start to see them starting to operate again and have a little bit of normalcy in their operations, then the expectations on the impact to earnings would certainly be less severe than what has been initially expected.
Thank you, Mark. Thank you, Mark. I have another question for this time for Yumin. How are REITs going to be affected by the rise of work from home and e-commerce? That's for you, Yumin.
Okay. I think there has been a lot of debates on whether work from home will make office space in a post-COVID world irrelevant or reduce the demand for office space. I'm in the camp that there should not be a material fall in demand for office space. Structurally, in a post-COVID environment, most corporates as well as most MNCs would have to implement social distancing in their office space to cater to their staff. And over the past few years, we have actually seen work density of space per office worker came down materially in the last 5 years. People are packed more densely in the office work environment currently. And this density might have to be increased in a post-COVID environment as people cannot be hot desking, people cannot be sitting too near each other. So while less people might be in the office, but the distancing within the office colleagues have to be increased in current environment. And if you look at the physical market transaction, even in this COVID environment, we have seen there are still long-term buyers that are keen to buy quality office assets within even Australia as well as the Singapore market, as people believe in buying into prime assets as a key long-term income driver for a lot of the pension funds as well as the long-term investors. On the e-commerce threat, it could be a bigger threat in certain areas, in certain countries in Asia, especially in Australia, but less so in Singapore and Hong Kong, where the culture of eating out, dining out, and meeting friends in neighborhood malls continues to be a lifestyle choice. Australia has definitely been more harder hit on e-commerce trends for their retailers, the discretionary retail malls, like what we see in the US, because the e-commerce sales in Australia has been growing much faster. And the area within REITs that are able to enjoy these trends will be the industrial REITs that have logistics assets or even warehousing capabilities. And they are actually enjoying very resilient demand in current environment where there will be more warehousing requirements as more tenants adopt a more omni-channel way of selling things, apart from physical stores, but also on online as well.
That's great to hear. So we will see industrial REITs benefiting from e-commerce. That's good. I have a question for Mark. Mark, in the Philippine market, would you what would be the updates on the launch of REITs in the Philippines? Would it be delayed because of COVID? Further delayed again?
Well, I think in terms of updates, we've seen that, well, almost everything was delayed. And I think it was expected that even on the REITs, that would also be delayed. I think in terms of the players that are planning to go to market, it's still so far Ayala Land that will go first. But in terms of the timing, that's still subject to, well, review. And in the meantime, I think the companies that were initially planning to do REITs would have stopgap funding measures such as bonds while they're waiting for market conditions to improve. So it's also a function of current market conditions in that you would not be able to get the ideal funding that you would want given that market valuations are currently depressed. In the Philippine scenario, what we've seen so far from the main players was that they have been giving some a holiday for rent payments, so that will have an impact on the retail rents that they will be collecting. And what we're also hearing is there would be an adjustment as to how they collect rents from tenants. This is also designed to support or to at least make sure that their tenant mix or they support their tenants. The tenants don't go out of business while we're coming out of the ECQ. But on the other hand, that also means that for the meantime, incomes of the mall operators would also be negatively impacted as they try to support not only their employees but also their tenants.
Thank you, Mark. That's good to hear. We're also very excited to see how the Philippines will launch its first REITs. We're way behind our neighbors on that aspect. Thanks OB for that question. By the way, I forgot to mention his name. I have one more question for you, Min. Which jurisdictions have implemented rental relief, and how long will this last? And are landlords in these jurisdictions also enjoying some sort of tax breaks because if they're going to be implementing rental reliefs?
Okay, I think the government measures pertaining to COVID differs from country to country. But let's focus on the big ones, the bigger REITs market in Asia Pacific, ex-Japan. In Australia case, the government has come out with this new code of conduct such that any tenants with annual turnover of 50 million or less and are able to prove that their business were badly affected, i.e. Sales were down by over 30%, they can approach the landlords to negotiate for some form of rent relief as well as some form of rent holidays for 6 months or more. That's for Australia. In the Singapore context, there's a new COVID bill that was passed by the government in April, and this also provides that any tenants who are badly affected by COVID in terms of their business are able to go to a third party to negotiate together with the landlord for any rent deferment of up to 6 months. Naturally, these measures that came out from Australia and Singapore were targeted more at the small middle enterprises, which were more badly affected in current environment as business have slowed down, and yet they will still have to pay rents to support their business. Currently, if that's the key, the takeaway, and the sector that has seen and more likely to have more tenants applying for this relief will be the landlords that own retail assets. It will be relatively lesser for industrial as well as for office landlords. Industrials, by virtue that a lot of the businesses are not as badly affected by COVID-19. And for officers, naturally, a lot of the REITs in Australia or Singapore, their office are the prime office buildings, and these are actually occupied by your bigger tenants and multinationals, and are not really your small and middle enterprises that will approach the landlord for rent relief.
Okay, thank you, Yumin. I think we have time for one question, and I think this question can be addressed to both speakers. So this came from an anonymous attendee. So we've seen that in March and April, I think after March and during April, we've seen both Philippine equities market and the Asia Pacific REIT market. They have both recovered. Is this a sign that we've reached the bottom last March? And if not, what would be our message to long-term investors? We can start with you, Mark.
I think, as discussed in the earlier slides, we have seen the market dip closer to 4,000. That's when, if you look at the circumstances during that period, we were in the early stages of seeing infections rise. We were in the process of forming the IATF, which is the Joint Task Force. We were organizing how or which industries to remain operating, which ones to shut. The financial markets were partly, we forgot to include them. That's why there was a market shutdown. So we've added that to the list. We've also ramped up testing capacity, I think, over the last 6 weeks, 7 weeks. And there have been daily updates from government. The LGUs where the cases have also been more active now compared to where we were in the middle of March. So I think in terms of the rebound was basically investors having a better sense of where policies or where the support from government will be coming from. So that has firmed up over the last 2 months. So that's why the market started to rebound, in that they're already pricing in that these efforts would eventually bear fruit. Now, if you remember the slides that we showed earlier, there are still risks that remain. And certainly the biggest overhang on the market is, of course, this fall in the markets was basically because of COVID. So for it to fall again, then the main risk is then COVID returning with a vengeance. So that would be your second round, your third round. And I believe that currently the reason why the market is consolidating at these levels around 5,500 is that as we go from the enhanced community quarantine going into the general quarantine with a modified ECQ in between, the market is also waiting if the previous measures enacted were enough to contain or eventually move us into a newer normal. So if that fails, then certainly you would see another leg down. But if that succeeds, then that would indicate that the market may start to move higher as investors price in that we're starting to get ahead of the virus.
Thanks, Mark. Yumin, your comments on the same question?
I think the rebound in April was largely due to investors taking cue that the pandemic seems to be slowing a bit with flattening of the infection curve in Europe as well as the US. And that gives people some comfort. And of course, back in March at the lows, a lot of the REITs were actually sold down very aggressively, have priced in a lot of negative. Now going forward, how it will dictate how the REITs perform. Firstly, like what Mark mentioned, it's very important that with this loosening of lockdown measures, it's very important there's no resurgence of a spike in infection case that will cause economies to go back to the lockdown mode again. That would further kick the recovery further down the road from second half of this year to maybe next year or worse. That's not so positive environment. And of course, the second risk that I see right now is there's been US-China tensions rising again. Hopefully that will not go to the boil or making some noise on trade and all this issue that might dent financial market sentiments. The key point to watch is when the circuit breaker is listed in Singapore, how would the tenant sales and traffic recovers to help the small middle enterprises as well as the small businesses resume their activities and help in their cash flows. This is also very important to make sure that when the circuit breaker ends, we don't see a sharp spike in bankruptcy rates of the small and middle enterprises. That might curtail any enthusiasm as well as optimism on the recovery of the economies.
Thank you, Yumin. Thank you, Mark, also. We're going to end here. For questions that were not answered today, you may direct these to your financial advisors or bankers, or you can send us a private message on our Facebook account. I would also like to remind everyone of the quick 3-question poll appearing in Slido. You can still input your responses there to help us with our future webinars. Finally, reminding everyone that a recording of this webinar will be posted on our social media account. Please watch out for that, particularly for those who came in a little bit late. Thank you for taking time to join us today and for actively participating in our Q&A and our survey. We hope that the insights our fund managers gave today can help you in your investment decisions for you to achieve your financial goals. Have a pleasant day ahead and stay safe always. Thank you.